Welcome back to Iron Financial. This is the only place on the street where we forge stronger portfolios by cutting right through the market weakness. I'm your lead analyst. Today, we're putting a giant of the healthcare industry under the microscope, HCA Healthcare. Now, this is a name that commands respect, a true titan, but the market's been sending some really mixed signals. So our job today is to stress test this company's structure to see if its foundation is as solid as the headlines say, or if there are some serious cracks forming right under the surface. We're going to break down the numbers, we'll analyze the strategy, and we will deliver a verdict you can take to the bank. All right, let's get to work. First things first, let's get a handle on the sheer scale we're dealing with here. HCA Healthcare isn't just, some hospital chain. It is a colossal system. As of their latest reports, we're talking about nearly 190 hospitals and close to 2,600 ambulatory sites. This includes everything from surgery centers and freestanding ERs to urgent care clinics. They're operating across 19 states and even have a footprint over in the United Kingdom. So look, this isn't just a company, it's a core piece of the American medical infrastructure. Its immense size is central to the bull case. It gives them economies of scale and negotiating power that the smaller players can only dream of. But as we all know, with great size comes great complexity, which brings us to the core tension of our analysis today. Exactly. And here is the central conflict, the one question that every single investor needs to be grappling with right now. This is your Market Skeptic, and my job is to ask the tough questions. On the surface, yeah, the recent Q1 earnings report looked like a beat. They topped expectations. But what did the stock do? It plunged. The market didn't react to the headline. It reacted to the weakness that was buried deep in the details. So the question we are forging an answer to today is this. Is HCA a financial fortress, an impenetrable castle of cash flow and shareholder returns? Or is it a house of cards, propped up by an immense amount of debt and some fancy financial engineering that's masking serious operational decay? That is the battleground. Let's start with the bull case. To understand where HCA is now, you first have to understand the incredibly powerful foundation they built in the full fiscal year of 2025. You can't analyze the first quarter of 2026 in a vacuum. The context from last year is absolutely critical because it showcases the raw financial power this machine can really generate. The numbers from 2025 are, frankly, staggering. They show a company that was operating at peak performance, building what looked like an unshakable financial structure. So let's lay the first stones of that fortress. Let's start with the top line. A number this big, it deserves a moment just to sink in. $75.6 billion in full-year revenue for 2025. This is not just a number, it's a statement of market dominance. This figure represents an incredible volume of patient care, of procedures and services delivered all across their vast network. It shows their ability to capture a massive share of healthcare spending in the country. And when you're operating at this kind of scale, you have incredible leverage over suppliers, over payers, and the market itself. This is the top-line power that fuels everything else in the company. And from that massive river of revenue, this is what drops to the bottom line. Nearly $6.8 billion in net income attributable to HCA. This is pure profit. It's the cash that funds the dividends, it's the ammunition for the share buybacks, and it's the capital for reinvestment and expansion. For a company in a sector that's often plagued by thin margins and these complex reimbursement battles, this level of profitability is a testament to their operational efficiency. This was the engine room of the fortress in 2025. Now for investors, this is the number that really moved the needle. A nearly 29% increase in full year 2025 adjusted earnings per share. This is what we call heavy lifting. It tells you that management wasn't just growing the company, they were creating value for shareholders at a really accelerated pace. This kind of EPS growth is what attracts big institutional money and drives the stock's valuation higher. It was a powerful signal of financial health and strategic execution throughout the entire year. So let's put it all together on one slide. Just look at this table. It's a blueprint of strength. You can see the year-over-year performance, and there is not a single weak link here. Revenue's up a solid 7.1%. Net income up a powerful 17.8%. Adjusted EBITDA, a key measure of core profitability, climbing over 12%. And as we just saw, diluted EPS surged an incredible 28.8%. This isn't just growth, it's broad-based, high-quality growth across every single key metric. In 2025, HCA wasn't just building a fortress, they were reinforcing every single wall and battlement. And you really can't argue with the CEO, Sam Hazen. He's right. They finished 2025 with incredible momentum. The numbers absolutely prove it. The fortress looked impregnable. But here's the skeptic's question. A fortress is only as strong as its ability to withstand a siege, and in the first quarter of 2026, the economic environment and patient trends, well, they began to change. So the real test isn't how strong the walls were built last year, it's whether they can withstand the pressures of today. Can this fortress actually take a punch? And that is the crucial point. So let's pivot to the most recent data and see how this build holds up. The first quarter of 2026 is our stress test. This is where the rubber meets the road. After a year of building that financial fortress, the first 3 months of this new year provided the first real challenge to its structural integrity. We're going to look for any signs of strain, any hairline fractures that might suggest the incredible performance of 2025 is not sustainable. Now, what's really telling about this slide is the deceleration. Just look at the drop from the left bar to the right. In the fourth quarter of 2025, they were still firing on all cylinders with 6.7% revenue growth. But just 1 quarter later, that growth rate slowed to 4.3%. That is a significant slowdown. And while it's still positive growth, the change in trajectory is a major warning signal for Wall Street. Momentum is clearly fading, and this is the first visible crack in the fortress armor. Okay, this is where it gets interesting, and frankly, a little concerning. You've got to look at this disconnect. On the left, you see net income growth. The actual profit the business generated was nearly flat, up just 0.6%. It barely budged. But on the right, earnings per share grew by a very healthy 10.9%. So how is that possible? How can profits be flat while the per-share earnings are soaring? Well, the answer, as we'll see, is aggressive financial engineering, primarily through massive share buybacks. They're just shrinking the denominator to make the ratio look good. But it begs the question, is this real operational growth, or is it a paper-shuffling exercise just to please Wall Street? And this slide, right here, this is the smoking gun for the bear case. This is why the market sold off the stock despite the so-called beat. Let's look past all the financial adjustments and focus on the real business, treating patients. Same facility inpatient surgeries were down. Same facility outpatient surgeries were down even more, by 1.7%. These are the high-margin critical procedures that drive profitability. This is the core of the business, and it's shrinking. Now, management pointed to a weaker respiratory season, and you can see the huge declines there. Respiratory admissions and ER visits just fell off a cliff. But the weakness in surgeries is a much, much bigger red flag. This indicates a potential softening in core demand for their most profitable services. These aren't just cracks. This is a potential weakness in the foundation itself. And here it is, straight from their own press release. This is the sentence that should make every single investor pause. They admit to unfavorable volume impacts, those surgery declines we just saw, but then they say it was mostly offset by recognizing Medicaid supplemental payments. So what does that mean in plain English? It means they're using one-time, policy-driven government payments, which they hadn't even included in their initial guidance, to plug the hole left by a weakening core business. This is the classic definition of using a temporary patch to cover up a structural problem. It makes the quarterly numbers look better, but it does absolutely nothing to fix the underlying issue of declining patient volumes in key areas. All right, so the skeptic has made his case, and the operational cracks, they're undeniable. But now we have to pivot to what is arguably the strongest pillar of the bull case for HCA, its incredible efficiency as a capital return machine. This company generates an enormous amount of cash flow from its operations, and management has been incredibly aggressive and crystal clear about its #1 priority, returning that capital directly to shareholders. This is where the argument shifts from operational health to financial strength and management's direct commitment to its investors. And this chart, it lays out the strategy perfectly. It breaks down how HCA deployed its capital in just the first quarter of 2026. Look at the biggest slice of the pie, over $1.5 billion spent on share buybacks. Now compare that to the $1.1 billion they spent on capital expenditures. That's, reinvesting in their own hospitals and clinics. And then you have a smaller but still significant slice for dividends. The message from management is crystal clear. Their top priority is not necessarily building new wings on hospitals, but buying back their own stock to support the share price and boost that EPS number. For many investors, this is exactly what they want to see. And this isn't just one action. It's a multi-pronged assault to reward shareholders. First, a stable and growing dividend, now at 78 cents per share. That's a reliable income stream. Second, the aggressive execution of buybacks. They took over 3 million shares off the market in a single quarter. Third, they reloaded the cannon, authorizing a massive new $10 billion repurchase program. And finally, despite that volume softness, they stood by their full-year guidance, signaling confidence to the market that they can manage through these headwinds. For the bulls, this is a picture of a confident, shareholder-friendly management team using its financial firepower to create value. Confidence or leverage? While we're talking about firepower, let's talk about the fuel for that fire. $48 billion. That is HCA's total debt as of March 31st, 2026. This isn't a small number. It's a mountain of liabilities sitting right on the balance sheet. All of this shareholder-friendly activity, the buybacks, the dividends, it's all happening in the context of this massive debt load. They are borrowing from the future to pay shareholders today. And that brings us to the ultimate question for this section. The bull sees a pillar of strength, a company using its balance sheet and cash flow to reward owners. But the skeptic has to ask, is this sustainable? Are they using financial leverage to mask the operational weakness we identified in those surgery volumes? Is this shareholder pay-up machine a durable engine of value creation, or is it running on fumes, powered by debt, while the core business sputters? This is the debate that will determine the stock's future. Okay, we've laid out both sides. We've examined the solid foundation built in 2025 and the stress cracks that appeared in early 2026. We've seen the operational headwinds and the powerful tailwind of shareholder returns. Now, it is time to put it all on the scales. We're going to weigh the bullish supports against the bearish cracks and forge the official iron financial verdict on HCA Healthcare. Let's break it down one last time. The bull case, the fortress argument, is built on undeniable financial might. They generated $2 billion in operating cash flow in a single quarter. That's incredible. They're using that cash for aggressive buybacks that directly boost EPS, they're paying a stable dividend, and management is projecting confidence by reaffirming their guidance. And you can never ever discount their immense scale and dominant market position. But the bear case is equally compelling. The cracks are real. Revenue growth is slowing down. The negative trends in high-margin surgeries are a major red flag about the health of the core business. That $48 billion debt load is a constant source of risk, especially if interest rates stay high. And their reliance on one-time Medicaid payments to make the quarter look better, it suggests they're patching over fundamental problems rather than solving them. So, after weighing all the evidence, here is the iron financial verdict. HCA Healthcare is a durable structure that is facing foundational stress. Now, this is not a house of cards about to collapse. The company's cash flow generation and market position provide it with a massive, durable framework. They have the financial machinery to weather a storm and continue rewarding shareholders. However, the cracks in its operational foundation, specifically the declining surgery volumes, are real, and they cannot be ignored. The market was right to be spooked. The core business is showing signs of fatigue, and management is using its financial prowess as a brace to support the whole structure. And so the crucial point is this, and this is the question we are going to leave you with. HCA is playing a game of chess right now. They are using buybacks, leverage, and one-time payments to support the stock while they navigate what appears to be a clear slowdown in their core business. The ultimate question is one of timing. Can this masterful financial engineering serve as a bridge to a period of renewed operational growth? Or is it simply a temporary patch that's just delaying the inevitable moment when the foundational stress becomes too great for the financial braces to hold? The answer to that will determine if HCA is a historic buying opportunity or a value trap in the making. Your job is to decide which side of that trade you're on. We'll see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.